Sentiments among property buyers here in Singapore aren't expected to be dampened even after the 10th consecutive rate hike by the US Federal Reserve to fight inflation in the United States. Market watchers are forecasting this to be the last raise that the Fed may actually impose. Now, they say that local interest rates could stabilise in the months to come as well. Over 70% of the 275 units at this condominium was snapped up on its first day of sales. Now, it's what market watchers say is a reflection of how local first-time buyers remain unfazed by local property mortgages that may be driven higher due to the Fed rate hikes. That's because Singapore manages an exchange rate-based monetary policy, which pegs the Sing dollar to a basket of currencies, of which the US dollar is a primary component. Now, that means that interest rates here are closely tied to US interest rates. One economist expects rates to taper after September, following a peak in the months to come.
As its economy starts to slow down and as inflationary pressures possibly fade in the US, we don't anticipate that the Fed will hike more. That will mean that the market rates already start to price in at when the Fed will cut, and that will help to decrease some of our short-term interest rates.
Meanwhile, factors like fewer new launches in recent months and strong buyers' appetite to acquire their own spaces are fueling demand. Still, analysts point out that the latest property cooling curbs, which include higher property taxes, could weigh on demand.
Most buyers will still be prudent and they will still buy within their means. So I think that in Singapore, I think as long as employment remains robust and there's income growth, then many of these locals and even long-term investors, they may continue to park their money here.